Hey guys, I'm Dan Rochon, and today I'm going to talk to you about the 1031 Tax Deferred Exchange and what that means to you as an investor and what it will mean if the current administration is successful at removing this 100-year rule that's been in our tax code for a century. And before I jump deep into that, I want to invite for you right now, if you've not been to this channel before, go ahead and subscribe and click that bell so that you'll be notified of great content that's going to be coming up that will share with you everything about local living in Northern Virginia, about owning real estate, investing, and really about working, playing, and living in Northern Virginia. So welcome, and today I'm going to share with you some great information about the 1031 Tax Deferred Exchange. All right, welcome back. What is the 1031 Tax Deferred Exchange? Well, this is a mechanism in the tax law that has been around for more than 100 years. And this allows for an investor or a homeowner that has an investment property to be able to roll and defer the taxes from one property to another. So it doesn't eliminate the taxes, at least during the time that you're living. What it does do is it defers the taxes so that in the future you'll have to pay the taxes on the last sale, but not today. So what does all that mean, and what are the technicalities to it, and what happens if that rule goes away? Because right now what's happening is the Biden administration has proposed that the 1031 Tax Deferred Exchange goes away. And if that happens, that's going to definitely impact our economy. It's definitely going to impact the opportunity as a real estate investor. Now, whether you're Republican, Democrat, Libertarian, I don't know, Green Party, whatever else, it doesn't really matter what your political viewpoints are. What matters is how will this impact you? Because I, as a real estate professional, have helped many Republicans do a 1031 Tax Deferred Exchange, and many Democrats do one as well. So this is not a political conversation. It is an economic conversation. All right, before I dive even deeper into this, I want to let you know I am not a CPA nor an attorney. I am a real estate broker, and I've been selling homes since 2007. So that's a little bit of disclaimer. So if I say anything that seems like tax advice or legal advice, it is just a general opinion, and go ahead and talk to your CPA, accountant, or whoever the qualified professional is. So the 1031 Tax Deferred Exchange, as I mentioned, has been around for 100 years, and it allows for you to be able to avoid paying taxes so that when you have an investment property, you sell that investment property, and then you take the proceeds from that and you reinvest them into a new investment. So what has to happen is you can't do this with your primary residence. With your primary residence, there's a what's called a capital gains exemption. I'll talk about that on a different video. This has to be for an investment property. So you live in your home A and you have an investment property. It could be a townhome. It could be a condominium. It could be a commercial property. Whatever that property is, as long as it's held as an investment, then you could sell that, defer any taxes that you otherwise would have to pay, and then be in a position so that you could buy the next property with those proceeds and continue pumping money basically into the economy and doing what the government has said they wanted us to do for the last 100 years, which is to invest into real estate and to own rather than not own. And so the 1031 does have a lot of technical rules. And what those rules are that you have to, when you sell the property, the investment property, you have to, within 45 days of selling that property, identify the next one. And then within 180 days, you have to be able to buy that next one. The last person, I'm actually working on 2 1031 exchanges right now with some of my clients. The last one that I did was with an elderly lady. I don't know if that's respectful or not. She was in her early 80s. So I think that's elderly, but either way. So she was in her early 80s. So I was a little bit I'm curious about what was causing her to do the 1031 originally, but then I realized that she was going to take advantage of the step up, and I'll talk to you more about that here in a second. But anyway, so she had approached me. She had a property in Occoquan, Virginia, and Occoquan, Virginia is a small little town that's in a big metropolis of Northern Virginia. That's right on the Occoquan River, right off of 95, going south from Alexandria into Woodbridge. And it's a quaint little. I love it. But she had this townhome that she had owned for probably like 20 years, 25 years, and it had no mortgage on it. She bought it for something like $50,000, and we ended up sold it for something like $425,000. So maybe she owned it for even more than 25 years. And so there was a pretty big amount of money between that 50 and that 425,000 that if she wasn't able to do the deferment, she would have been taxed on. So she was able to take that money. She identified 2 properties in Stafford, Virginia, right outside of Stafford, single-family homes. She purchased those 2 single-family homes, and she was able to then rent those single-family homes out. She was able to increase her net worth through doing this because she was able to really get a good value on those properties, and she was able to increased her beneficiaries' net worth, because what happens, one of the things with the 1031 tax deferred exchange, I mentioned it a few times already, there's a thing called a step-up rule. And what that means is when you pass away, the property that your heirs inherit is going to be stepped up to the local market value. And then whoever inherits that is taxed on any gain from that point moving forward. So the 1031 allows her to be able to move the money through without getting taxed, and then be able to pass it on to an heir without them being taxed as well. So that's one of the technicalities in the rules that would benefit your heirs for sure. So when you're buying a property or you're using a 1031, I mentioned it does get wonky. It gets technical. I promise I'm going to go through this in a simple manner, right? But some of the rules that you're going to want to know, there's 3 rules when you're using the 1031 tax deferred exchange on how to be able to get the next property. So those 3 rules are called the 3 property rule, the 200% rule, and the 95% rule. So the 3 property rule is during that 45-day period, so you sell, let's say it's August 30th. You have 45 days from there, so whatever date that would be, August 31st. I thought I was going to do like an easy math on this, but maybe not. 45 days from that date, whatever date that is, August, September, September something, September 14th or 15th. You're going to, 45 days, you have to identify the property. So with the 3 property rule, you could identify 3 properties that you could potentially purchase one of those properties. Then, within 180 days from the time that you sold the first property you have to be able to purchase one of those 3 properties. The next rule is called the 200% rule. So for easy math, I know these numbers won't make sense. Let's say you sold this property for $100,000, and there's a $100,000 gain on here. Again, just using easy math. You could do what's called the 200% rule, which is you can identify up to, in this case, $200,000 of property that you could potentially purchase. That could be 1 property. That could be 15 properties. Now, if you find 15 properties for $200,000 in Northern Virginia, give me a call. I want to talk to you. It doesn't exist. It probably doesn't exist anywhere in the country. Well, maybe there's some pockets that it exists. All right, but either way, so that's the 200% rule. And then there's the 95% rule. So what the 95% rule says is that you can identify as many properties as you want, as long as you end up purchasing 95% of the value of the first property that you sold. So again, I know that it gets wonky, these rules, which is why you probably really do need a professional to be able to guide you through this. But those are the different rules that you have there. So then the next thing to notate is, so that lady that I helped, she was a sweetheart, by the way, the one I helped with the property in Occoquan, she wanted to take some money out from the sale. And and she was going to give it to somebody. She was going to give it to her grandson, because I think her grandson was getting ready to get married, and it was going to be a very significant gift. So what she did was she took $20,000 out of the sale of the proceeds before she invested into those 2 properties in Stafford or near Stafford, and she took that $20,000 and she paid taxes on that $20,000 only. So that's what they call is a boot. And so the boot allows for you to be able to sell, to take a small portion of the proceeds out, and then pay taxes on that small portion of the proceeds. Now, the rest of the money has got to go into what's called a qualified intermediator. Intermediator. Think of the qualified intermediator as sort of like just a third party that's going to manage all the money so that there's no commingling, there's no mistakes, and that the money is properly accounted for. So any money that you do the 1031 exchange on has to be accounted for properly, and that's why we have these people called QIs or qualified intermediators who are actually licensed to be able to take that money, keep it into an escrow, a third party, and be able to manage it so that you don't get into any trouble. Now, that's what a 1031 is. So the current administration right now is suggesting to get rid of that rule, and what their current suggestion is that if you're a single person and you do a sale, that you could be exempt for $500,000, and then you pay above that, and if you're a married couple, for $1 million, and then you pay on top of that. Now, that being said, make sure you understand this is just proposals right now. So by the time, if this ever gets into a law, or if the law ever changes, it may look very different than what I just explained to you. Okay, but that's what it is right now. So if you had a $300,000 property that appreciated up to $800,000, that $500,000 of that gain would be exempt, which sounds great. All right, it's like, okay, well that's decent. That's not a bad amount of money, up to $1 million if we're married. Except what you have to understand is right now the capital gains tax maxes out at just a little bit less than 24%. So if there's $100,000 of a gain for the federal tax, it's actually I think 23.6%. That they would end up paying $23,600 to the federal, to the country, and then whatever you're going to pay to your state on top of that. So that's what the current capital gains is. They're proposing that if it's more than $1 million, that they increase it to ordinary taxable income, as though if you're getting taxed as though if you were earning the money, going to to make bottles. I'm just looking at my bottle right here. You're the bottle maker. Whatever it is that you do for your full-time job, that you're going to tax you like that, which is going to increase that taxes all the way up to 37 to almost 40%. So either way, and I hope I didn't just lose you. I know I'm throwing a lot of numbers at you. If you want, give me a call, and I can talk to you through your situation so that you can understand. I know that there's a lot of data being thrown at you right now, and sometimes that's a lot, right? But I can break it down for your situation to help you understand. So these are some of the things right now that are being proposed. Is that a good thing? Well, in my opinion, if 100 years of administrations, Republican and Democratic administrations, thought that this was a good idea, and it has been tested through time to be able to impact our economy positively, I think it's probably a bad idea for them to get rid of a rule that has been helping our economy for years and years and years. Now, I respect that you may have a different opinion on it. I get it. That's okay. I respect you. I really do. But the thing about this is to understand that if they get rid of that rule, the effects into the economy. Let me put it this way. So let's say that you own a business. We're coming out of a pandemic. Some people would say, well, let's cut all of our marketing costs. Let's cut, if you're running a business, let's cut all the money that we're going to use to be able to build the business because we're scared because we're coming out of a pandemic. That's option A. Or option B. Let's do what we already know works, and let's do that on steroids. Let's put more money into the marketing budget. Let's do more content. Let's do more video content, right? Let's do whatever it is to be able to create results. Do more of it. So in my opinion, I think that it would benefit the economy to actually look at doing more rules that keep the money in our economy rather than less rules that take the money away. And you may say, well, this is for wealthy people. I get that. It's not for wealthy people. I have actually had 80 high net worth. Every single person I've done a 1031 tax deferred exchange with has been an ordinary person, just like you, just like me. Nobody has been ultra wealthy that I've done this. Now, do the ultra wealthy benefit from this? Yes. But I have seen ordinary people become millionaires through real estate investing. I haven't even seen it. I've helped them to become millionaires through real estate investing by being able to be able to understand how to be able to grow their net worth. And that's something I'd be happy to be able to talk to you about as well. Thanks for watching today. If I can help you in any way, if you're thinking about real estate investing, if you already own an investment and you're thinking about doing a 1031 and you're looking for somebody that can keep you out of trouble and save you money and actually help you make more money, give me a call, and look forward to helping you. Thanks.